This content is for educational purposes only and is not financial advice. Consult a qualified advisor before investing. Welcome back to Understanding Money. Today, we're going on a hands-on journey to the heart of investing, where every decision is a trade-off between risk and reward. You'll discover what those buzzwords really mean, why they matter, and, by the end, how to match your own personality and dreams to the investing style that fits you like a glove. Let's talk psychology, real-life stories, practical frameworks, and even some fun exercises to honestly assess your risk tolerance. Grab your favorite drink, open your notes, and let's make this the most valuable financial video you see today. 1. Risk, more than just losing money. Let's start with a story. Imagine you invest $10,000 in the stock market. The next month, your account is down to $8,500. How do you feel? Some people shrug. Markets fluctuate, I'll wait it out. Some can't sleep, obsessively check their account, or want to cash out. But did you know, risk isn't only about losses. In investing, risk means any uncertainty. Your actual results could be higher or lower than what you expect. Both the good and the bad are risk. It's the range, the unpredictability, the chance that things won't go strictly according to plan. Types of risk explained. Market risk. The entire market swings, like 2008, 2020, or that weird drop last month. Company risk. Enron or Lehman, one business tanks, no matter what the world's doing. Sector risk. Tech booms, then busts. Real estate bubbles pop. Liquidity risk. You can't find a buyer when you need to sell. Think real estate or rare collectibles. Inflation risk. Your money grows, but prices rise even faster. Buying power drops. Sometimes risk is missing your goal because you played it too safe, so you need upside too. 2. The deep meaning of reward. When you hear reward, think opportunity. Historically, US stocks, 8-10% average annual return. But some years rocket up 30%, others drop 25%. Bonds, 3-5% per year. Rarely gain huge, barely lose. Savings account / cash about 1-2%. Super steady, but usually doesn't keep up with inflation. Here's the kicker. If we didn't hope for more reward, who would ever accept risk? Great investors know the secret isn't avoiding risk entirely, but being smart about aiming for enough reward for the risks you take. 3. The seesaw. No free lunch in investing. Let's picture a seesaw. On one end, safety. On the other, opportunity. You can't have both perfectly balanced. Super safe equals tiny returns. Chasing huge returns equals wild swings and possible stomachaches. This is the real trade-off behind every investment product, from stable government bonds to wild cryptocurrencies. 4. How do you experience risk? Interactive exercise. Let's have a real talk. Close your eyes and picture your portfolio is up 20% in a year. How do you feel? What about down 20%? Does that make you excited, anxious, curious, frozen, or motivated? Write down the first feelings that come to mind. Now, how did you react during past market drops, March 2020, or maybe just a bad day in crypto? Did you sell, buy more, or do nothing? Be honest. It's better to match your investments with your true feelings, not what the pros say you should do. Bonus, quiz yourself. I check my investment balance. Daily, monthly, quarterly, never. If I lost 30% on paper, I would sell, worry, but hold, do nothing, buy more. 5. Understanding risk tolerance, the Goldilocks zone. Think of your perfect investing style like picking the right temperature porridge, not too hot, not too cold. Your Goldilocks zone balances your sleep at night factor, your goals, how much you want to grow your money, your time horizon, how long until you need the money. If risk makes you anxious, you'll abandon a strategy at the worst time. The best investing plan is the one you'll actually stick with for decades. Shakes classic investing styles. Let's get specific. A. Conservative, who it fits, retirees, near-term goals, anyone who can't bear seeing ups and downs. Mix 80-90% bonds and cash, 10-20% stocks. Expect slow, steady returns, but probably won't outpace inflation. Example. Grandma Pat, who wants her nest egg safe and steady for peace of mind. B. Balanced who it fits. Most savers, those 5 to 20 years from needing the money. Make 60-40 or 70-30 stocks post bonds. Expect moderate returns. Can handle moderate drops. Example, young family saving for a home and college at the same time. C. Aggressive growth who it fits. Young professionals, long-termers, people who love risk. Mix 80 to 100% stocks, including international or small-cap funds. Expect big growth potential, but also big swings. Bear markets will happen. Example, 25-year-old maxing out their 401k won't touch the money for 30-plus years. D. Income alternative. Who it fits. Early retirees, people seeking steady cash flow. Mix dividend-paying stocks, REITs, bonds, maybe peer-to-peer or rental real estate. Expect more income, less roller coaster, but still must-watch risks with yield chasing. 7. Portfolio building blocks. What risk looks like in different assets. Blue chip stocks, Apple, Johnson & Johnson. Moderate volatility, steady growth, dividends. Growth stocks, Tesla, Nvidia. Huge potential, huge ups and downs, rarely pay dividends. Small cap stocks, smaller, newer companies. Big swings, sometimes big returns. International, emerging markets, diversifies home bias but adds currency political risk. Government bonds, US Treasury. Super safe, very low yield. Corporate bonds, slightly higher yield, a touch more risk. High yield junk bonds, big returns, but risk of default is real. REITs, real estate for the everyday investor. Pay solid dividends, but real estate markets can swing. Commodities, gold, oil, agriculture, can jump in times of crisis but unpredictable. Crypto, alternatives, wildcards. Can skyrocket or crash, never put in more than you can afford to lose. 8. How to actually decide your mix. Actionable framework. Time horizon. The more years until you need the money, the more risk you can take. Goal. Saving for a wedding. College. Retirement. Your target influences your style. Behavior. History of panic selling. Lean conservative. Love the thrill and can stomach losses. Go higher risk. Tip. Try an online risk tolerance quiz, like Vanguard's or Schwab's, to get a sense of your comfort zone. 9. Managing emotions and behavior. Your mind is the biggest risk, money is emotional. During booms, everyone feels like a genius. During crashes, fear and regret take over. Build systems, not hunches. Automate deposits. Automate rebalancing if possible. Stay accountable. Talk to a friend or advisor, or write a brief Why I Invest letter to yourself to read in tough times. Behavioral biases to watch for. Loss aversion. Losses feel twice as bad as gains feel good. Recency bias. Overweighting the last big swing. Herd mentality. Tuning your risk to whatever's trending, resist. 10. Rebalancing and adapting over time. Markets change, and so does your life. Marriage, job change, kids, nearing retirement. Rebalancing means adjusting your mix to match your ideal style. Example, if stocks soar and become 80% of your portfolio when you wanted 60%, sell some and buy bonds to restore balance. Goals shift too. It's normal to move from aggressive to conservative, or vice versa, as you grow. 11. Deep dive. Real investor case studies. Aya, young professional. Started 100% stocks at 24. Felt fine during up years. But after a 25% drop, realized she couldn't sleep. Added bonds. Felt instantly calmer. Stayed invested through rebounds. And now is glad for the smoother ride. Jordan, midlife income focus. Thought dividend stocks were boring, but loved seeing regular payouts during market slumps. Now reinvests during his working years and plans to withdraw for income in retirement. Priya, entrepreneur, high risk tolerance, allocates a portion to startups and crypto for potential windfall, but keeps core wealth in index funds and real estate. My risk style is 80% boring, 20% wild. Maria and Leo, retired couple. Hold mostly bonds and dividend index funds. Stay active in local clubs instead of tracking stocks daily. Peace of mind is our number one reward. 12. Finding your sweet spot. and sticking with it. If you're bored by your portfolio, you're probably invested right. Your perfect investing style is one where you can sleep at night, stick with your plan, and get to your goals without drama. Review your plan annually, not daily, and only make gradual adjustments if your goals or situation really change. 13. Your interactive action plan. Write your biggest financial goal and the date you'd like to reach it. Imagine a 50% drop in 1 year. How would you react? Take a risk tolerance quiz and discuss results with a partner or friend. Pick a basic portfolio model: conservative, balanced, aggressive, or income. Allocate your investments accordingly using index funds, bonds, and any fund money for high-risk assets. Automate contributions and set up an annual calendar reminder to review. Bonus: start an investing journal. Log your feelings after big market moves. 14. Final takeaways. Your investing identity. There's no perfect risk-reward mix, only the one that fits you. Don't chase the crowd. Don't let fear, greed, or FOMO dictate your decisions. Embrace your style, automate your process, and enjoy the journey. Like this deep dive? Smash like, subscribe, and comment below. What's your risk style? And what's one lesson you've learned about risk and reward? For more practical, real talk investing guidance, stay tuned to Understanding Money. And remember, this is educational, not advice. Always do your research and stay true to yourself. Thanks for watching, and here's to a rewarding financial journey your way.